can see halftime report 2013. That means we're halfway through the year. Okay, we always start with these with a little bit of warm-up. So we're going to ask about 3 questions on some words and see if you can know what they are. Who knows what tapering is? Narrowing. Exactly, but what are we narrowing? What's been the conversation this year? For many months now, the Fed has been purchasing $85 billion worth of securities, half mortgage-backed, half treasuries, in an effort to push down long rates and sort of support business growth, hiring, borrowing for real estate and everything. And so tapering is, as Greg said, Federal Reserve lowering the amount of purchases. We're going to talk a little bit more about this. This is actually very important for May and June, what happened in markets. Who knows what this is? Great rotation. You'll notice there's a pattern here. Yes, there's a theory. You always C is always the safe answer. There's a theory that there's all this money for the last 5 years has gone into fixed income, which has sort of finished off the inflation of a bond bubble. And you've heard me talk about this for about 2 or 3 years. And there's a theory that as that bond bubble starts to collapse, people will sell a whole bunch of fixed income and buy equities. Now, when you hear this in the media, I want you to ask yourself a question. How likely is it that people, remembering 2008, remembering 2001, are going to suddenly flock into the equity markets for safety? Right? Hardly likely. Okay. Who knows what this is? B, no. No, it's this is the large cuts and then the tax increases that reduced GDP upwards of maybe 2% is what the estimates were earlier in the year. How many people think that that's had the effect that everyone expected? Right.
What was expected?
Depends on who's expected.
Exactly. It depends on who you're reading, right? It depends on which side of the aisle, which economist you're talking to. But there was an expectation that it was going to destroy growth in the first half of the year. And it may have reduced growth, but it didn't destroy it. Well, we'll talk more. Okay. Now, this one is my favorite. I'm not going to put the words up there. What most popular word on the tabloid covers this last year? Think about what just happened. Big deal. What was it? Baby. Yeah, that's right. Which baby? The baby. All right. So we have a very simple Post-it note agenda: past, present, future. Get into the past. So before I put them up here, what did the S&P do first half of the year through the end of June? A little bit over 12. What about gold? A lot, right? Silver down 35%, commodity complex totally down 10%. It's kind of just what's happened in the first 6 months of 2013. And we've got a lot of expert opinions. The last one here is probably the most important. But you got Bill Miller, who ran the Legg Mason Value Fund that did so well for so long, and then has underperformed for about 3 years. And everyone said he was done, but he's actually done incredibly well over the lifespan of his portfolios. Great bond bear market has begun. Notice when this is, January 11th, 2013. Actually, the bear started probably in May for the bond market, May 9th. So Bill Gross operates with, what do they call them? Smoothed PE ratios. So he looks at long-term earning expectations. And he's saying that for every asset class, you can expect low returns for quite some time. And then Carl Case from Wellesley. How do you say that? Wellesley? Wellesley. Wellesley. A lot of reason to be optimistic, but cautiously so. And I agree with that. Okay, here's the expert opinions you have to hear.
The stock market is really unpredictable.
Yeah, we learned how to read stock tickers.
And we also learned PE ratio.
Yeah, PE ratio.
started the third grade with $100,000, and by the time you were done with the school year, how much money did you have?
$150,000.
$150,000. That means you got a 50% return. How did you do it?
We invested in Apple and Macy's. Apple was our best stock and Macy's was our second one.
Also, we got some bonds and mutual funds from Vanguard and Goldman Sachs.
Your biggest holding was Apple. Why did you pick Apple?
Apple has great products like the iPhone and iPads.
So since the iPhone 5 came out just a couple of weeks ago, Apple stock hasn't been doing so well. What do you guys think? Is it still a good investment?
Good investment only if you invested in a few years, like last year, because when we ended, it was like $687 a share.
What's your best investing advice for your parents or your friends?
First, you have to see how it's history, and then second,
You can look at the graph.
yeah, and then second is what it makes and what is important of what it makes.
If you guys made $50,000 in real life, what would you do with it?
With the money, I don't really know what to do with
Yeah,
$50,000.
that's a lot.
Yeah.
Would you save it for college or go on vacation or buy something?
Maybe just for college.
Yeah, because
growing
college
up.
is really expensive.
So they actually have some good ideas there, but they did really well for 1 year, and then the holdings that they had that year cratered the next year. I don't want to make fun of second graders or third graders, but just humor. So this is kind of where we are in most domestic markets. You know, we're reaching some all-time highs. We've had the best first half since 1999. The question is can it last? Is it sustainable? In just a minute, we'll talk a little bit about the psychology that's behind this upward movement in markets. But there is this long-term history where the average rally, once you hit that all-time high, has another 28% to increase. Maybe that happens, maybe it doesn't. It's just an interesting statistic that we can put up there. But it is unwise to sell right when it hits that that new high point, because there's a lot of momentum, a lot of joy that comes afterwards. Okay, but, right, economic recovery, things are starting to take off, and yet there's this big drag. This is that sequestration, this is increased taxes, this is probable continuation. So if you read a lot of this stuff, you hear that many government entities did not cut right away in expectation that these things would be turned back. And they haven't been turned back. So they may have to cut even deeper in the second half of the year to make things, to meet their budgets. They're going to be over budget unless they change what they've done so far. So this we may still see more drag from sequestration or from these fiscal items. Okay, which is this government austerity, and you can kind of see the difference in the three different from the U.S. I can't read this thing. Britain and the Eurozone. Okay, you see that the U.S. actually this year has increased their austerity, where everyone else has kind of declined a little bit in the austerity. So the question is, were we ahead of the curve, or are we behind the curve? So Europe has been under tons of austerity for a fairly long period of time. We didn't do austerity to start. We pumped the whole world full of cash and through dollars. And now we're just now getting our fiscal house in order, maybe. So are we ahead? I mean, did we do the right thing with that, with the stimulus? Or do we now have problems coming down the pipe? We have to invest now going forward, not knowing what the outcome might be. And there's a certain amount of anxiety with that and unpredictability with that. And I think that there's arguments, as you very clear, on both sides of the aisle. And I think that underneath, 2%, underneath, actually, what is it? Underneath, if you have debt growth deficit underneath your growth rate, then slowly but surely your debt load relative to GDP is declining, right? So, and that's okay. The question is, could we do what we've done for so long? We've talked about this a lot in the past, in the last couple of presentations, and I would say look at some of the slides we have in the previous presentations, because we go in depth about this exact topic. Okay, but this is what I'm trying to get to right here, is that, so we had that 2% growth, even though we have a 2% drag due to austerity. So where did that growth come from? And the question is, would it have been 4? Remember, would it have been 4 if we didn't have the austerity? The problem is the thing that we're borrowing from is savings. So that the U.S. consumer is spending more now than they were prior, they're saving less now than they were prior to sequestration, right? So it's not necessarily that, and I asked this at a JP Morgan conference, and I stood up and I said, you're telling us that we would have had 4% growth were it not for this sequestration, because that's what they want us to believe. But I don't think that's necessarily true. I think the reason we have the growth that we have is because people aren't saving the way they need to save. So the trade-off is not the one they're suggesting it is. It doesn't mean we wouldn't have had more growth. It just means that maybe it would have come from a better source, right? It would have come from, not from our savings, but from their savings. Does that make sense? All right. So the other thing is we have confidence at 5-year highs. This is often a contrary indicator. We know this, right? Wage growth, very, very, very low. And we're going to see a brief video in a second. But it's, since 2009, it's been less than 2%. If wage growth is less than 2%, and savings has gone from 6, slowly ticked down to 2% or 1.8%, we don't have much more we can dig into our pockets and spend. And if we're 71% of the economy, which we are, that's a problem. Okay, we'll talk a little bit about corporate profits, which we're all getting excited about the macro story. We're all getting excited about Bernanke feeding the engine with quantitative easing, with more money buying these bonds, with continued low rates. But at the same time, companies are making less money that are not financial companies. Financial companies are doing incredibly well. Other companies, not so much.